Late last night, when most traders were asleep, the Federal Reserve set the global markets on fire. Within just a few hours, three powerful voices, all senior Fed officials, broke rank and fired verbal shots at Chair Jerome Powell's latest rate cut. What happened wasn't just a disagreement, it was an open rebellion. For months, markets have been celebrating the idea that the Fed would keep cutting interest rates, that the era of cheap money was making a grand comeback. But this week, that illusion cracked. The first shot came from Kansas City's Schmid, a voting member this year. His message was loud and sharp. I oppose the rate cut. Inflation isn't done yet. Then came Dallas Fed's Logan, saying she saw little room for another cut. And as the clock struck midnight, Cleveland's Loretta Mester confessed she almost voted to hold rates steady. 3 statements. One night. One message. Stop betting on endless cuts. Inflation is still alive. The market reaction was instant. Futures tumbled. The US dollar surged. And by dawn, traders realized something had changed. The Federal Reserve, once united, is now split down the middle. It's rare to see the Federal Reserve air its internal divisions so publicly, and even rarer to see 3 officials take the stage within hours of each other. This wasn't coincidence, it was coordination. Until now, markets believed the Fed had a clear direction, a gradual easing cycle to support slowing growth. But the 3 shots changed everything. The first key point, this was a communication strategy. The Fed knows its words move markets more than its actions sometimes. So, when inflation data came in hotter than expected, these hawkish officials stepped out to reset expectations, to cool down excessive optimism about rate cuts. The second key point, this move exposes deep disagreement inside the Fed. Powell's team of doves still see risk in a potential slowdown, but the hawks, especially those from regions like Kansas City and Dallas, worry that inflation could rebound if policy loosens too much. The message to Wall Street is simple. Stop expecting a one-way easing path. Monetary policy has re-entered the gray zone, where uncertainty rules. At 8:30 p.m., Beijing time, the first shot was fired. Kansas City Fed President Jeffrey Schmid, a current voting member, issued a rare statement of dissent. He said, I oppose the 25 basis point cut. The labor market is balanced, growth continues, but inflation remains high. That sentence tells us everything. In his view, the economy is not weak, and the inflation threat still lingers. Schmid's words strike at the heart of Powell's justification for easing. His second line hit even harder. Policy is only slightly restrictive. I believe rates should have stayed unchanged. Translation? The Fed hasn't done enough to tighten. Why does this matter? Because Schmid is a voting member. His dissent counts. It sends a formal signal to the markets that Powell's cut-and-hold strategy is under attack from within. Historically, when dissent inside the Fed rises, volatility follows. Remember 2018? When officials disagreed over tightening too fast, it triggered one of the worst year-end market sell-offs in a decade. We may be on the verge of something similar. A tug-of-war between growth support and inflation control. Then came the follow-up fire. Almost like clockwork. At 9 p.m., Dallas Fed President Logan stepped up and said she preferred no rate change this week. She added, I see little room for another cut in December. Just 3 hours later, at midnight, Cleveland Fed's Loretta Mester confirmed she had almost voted to hold rates steady. She added that current rates are close to neutral, meaning she believes monetary policy is already in balance. Not too tight, not too loose. Together, these 2 statements amplified Schmid's message. No more easy money. 90% chance of another cut in December. After this triple dissent, that probability collapsed to around 50%. The key takeaway. This is not just noise. When regional Fed presidents coordinate like this, Dallas, Cleveland, and Kansas City, it reflects real pressure inside the FOMC. They're telling Powell, we've gone far enough. It's a warning that December could bring not another cut, but a pause, or even a policy fight. At this point, imagine Jerome Powell as a captain steering a ship through fog. Behind him, half the crew shouts, slow down, the storm is coming, while the other half yells, speed up, we're losing momentum. That's what the Federal Reserve looks like right now. Powell faces two opposing forces: the doves, who see recession risks and want to preempt economic slowdown; the hawks, who see sticky inflation and fear repeating the mistakes of the 1970s, when easing too soon caused prices to surge again. Neither side is wrong. The economy is giving mixed signals. Growth remains decent, unemployment is low, but inflation is still above target. That's the perfect recipe for policy confusion. When the Fed is divided, markets lose their compass. Investors no longer trade on fundamentals. They trade on words, tone, and inference. Every speech, every line in the minutes becomes a battlefield. Powell's biggest challenge now is not inflation, it's credibility. If the public starts seeing the Fed as politically divided or indecisive, the central bank's power to influence expectations could erode. Looking ahead, the real showdown will be at the December Federal Open Market Committee meeting. That's when we'll know whether Powell still controls the narrative or whether the hawks have taken the wheel. The market's focus now shifts to three global crosswinds. One, China's upcoming economic stimulus plan, rumored to boost infrastructure and technology spending. Two, gold, which is nearing its technical bottom, signaling investors' growing fear of financial instability. Three, the US dollar, the most powerful signal of all. If it keeps rising, it could crush global equities and commodities. Wall Street strategists are already warning that the current calm may be deceptive. Liquidity remains high, but confidence is cracking. A single hawkish surprise in December could send bond yields higher and equities lower, fast. In our November outlook, we describe this moment as the calm before the potential storm. Because sometimes before the storm hits, everything feels too quiet. And right now, the markets are very, very quiet.